This is your lunch. Now, you should be able to do whatever you want to with this, right? If you want to eat all of it, great. If you want to throw it away in the garbage, that's your prerogative. But here I come, the government, and I get to take 40% of your lunch. And that, Lauren, is how taxes work.
That's not fair.
You're learning. Uh-oh. Capital gains tax.
I love it. He takes a big bite out of the sandwich, and then
he is so deadpan hilarious. He is so deadpan hilarious. Yeah, that show was just. Sometimes it was brutal.
I'm sorry. I'm
deadpan and funny, and Ron himself, man, he was just. He was. The irony there is he worked for the government. Mm-hmm. And yet he didn't trust the government, right? So it's that happy balance that you have to find on one hand. I mean, like we work with so many federal employees and state employees here in Maryland and in our offices in Baton Rouge and our offices in Florida and Michigan and everywhere else. So we deal a lot with people who do rely on the government for their pensions, right? Mm-hmm. So on one hand, you don't want to mock them too much, but on the other hand, every single one of those people understands that the government, regardless if it's the state or federal, they're not good stewards with our money. They don't spend our money wisely. They certainly wouldn't spend the money the way we would want them to spend it, right? Mm-hmm. I mean, we can agree to disagree on what's appropriate for them to spend, but I think everybody thinks they spend too much, regardless of what. Of course. Regardless of where the cuts are. And Ron's point about that 40% for the taxes and don't forget capital gains taxes. I mean, we talk about that all the time, right? How can you, who would possibly volunteer? I mean, other than that little girl bringing the lunch stand, who would possibly volunteer to say, look, I want to make an investment that every time I get $1 out of my investment, Uncle Sam or some form of government is going to take 20, 30 to 40% right off the top. Nobody would choose to do that. And yet what we find, and it doesn't matter if you're a federal employee, a state employee, or never worked for a government organization, you're paying too much in taxes. Somebody told you along the way that paying taxes was something you were supposed to do. And yes, you're supposed to file your taxes. And yes, if you owe money or you have to pay, you do have to do those things. But there's plenty of court cases out there that say that you're allowed to arrange your financial affairs in such a manner as to pay the least amount of taxes legally possible. And the least amount of taxes legally possible is zero. So why would you not situate yourself in such a way to pay those zero taxes? And like a prime example, we had a caller come in, they called the office and wanted to sit down and talk. Don had a long conversation with them. Normally it's about 15 minutes, but Don had a really long conversation with them because they acknowledged that their only savings they really had, the only money they really had was all tied up in their business. They owned the building. It had a couple different types of businesses in there. One of them they owned. One of them was rented out to somebody else. And the business was designed in one way, and they had sat down with their CPA and they were getting ready to retire, and altogether the business and the building and all that was worth about $2 million. So it was a big nest egg, and they had the building for years and years and years. So they had depreciated. So their cost basis was very, very small. They were going to have a huge tax bill, and they'd been working with the CPA for years and years and years, and he had done a great job for them, evidently, calculating numbers every year and telling them what to pay tax-wise. But they had heard us talking on the radio about don't volunteer to pay taxes that aren't necessary, right? Don't volunteer to arrange your investments and your affairs and your income in such a way that you're paying taxes at that 20, 30, 40% bracket if you can just as easily arrange your affairs to be paying tax in the 0% tax bracket. If you have a choice, why would you choose to arrange your affairs to pay 20 to 30 to 40%? And that's exactly why they called. And if you're thinking to yourself the same thing, here I am, I'm at or near retirement, I'm thinking about the taxes, I'm thinking about my income streams, and I'm looking at it as, do I really want to lose that 20 to 30, 40% right off the top like Ron was alluding to? Do I want to be in that position, or would I rather be in a position where I'm putting that money in my pocket, where I'm getting to choose how to spend that money, and instead of being told we're going to spend it on things that, quite frankly, we all agree are pretty stupid. If you don't want to be in that position and you're finding yourself thinking about, maybe I am in that position, sit down with Ryan, myself, and our team, and we will show you how to create those income streams that you will never outlive. We're going to talk to you about how much you're paying in fees, the risk you're taking, long-term care, estate planning, and folks, taxes, taxes, taxes. I know everybody thinks we only have 2 years left of really true tax planning. No. Tax planning is today and for the rest of your life. It is not a one and done thing. You cannot solve your future tax problems with one meeting or one tax plan or only doing it once. This is a lifetime commitment. Let us help you find out, can you get to that 0% tax bracket?
Mike, you talk about, and I know this is personal for you because you see the mistakes us, make by not doing anything, by not taking action. You say we can lose 20 to 30% if we don't do anything because of taxes. But yet here we are worried about our portfolios losing 20, 30% with a market downturn. But if we don't do anything, the market could be great, and we're still losing that amount of money with taxes if we don't have a plan.
Absolutely. And that's what I was talking about before, was that these folks, were selling their building, and they knew they were going to take the money, they were going to take the proceeds, and it wasn't like they were going to spend the millions all at once. They were going to invest the money, right? And that makes perfect sense because they wanted to create that income stream.
Sure.
And so the purpose of their call and the purpose of them coming in was their CPA had just sat down and said, this is what your tax bill is going to be, which is insane. I mean, the CPA literally just said, you're going to pay $1 million in taxes and just call it a day, between the 20% to the federal and basically the 10%. It's under 10%, but just around 10% that you're going to pay to the state of Maryland. Just cut a check for that 30% and call it a day, and you'll have a couple $1 million left over, and you should be happy. And when they explained that to me, thank God I actually had a baseball cap on, because I think that's what kept my brains from exploding out of the top. And as they're explaining this to me, they could just see my face is getting beet red, and I mean they could tell I'm ready to explode. And I'm like, guys, I don't want to be disrespectful to your CPA, but that is the dumbest thing I've ever heard. Why would you? Here's what I promise you I'll do. If you write a check for $1 million, I promise to come to your house and beat you with a wet stick. I will beat you to death with a wet noodle. Absolutely crazy for you to turn over $1 million. Unless you think they're going to do something really smart with your money, I'd rather have you donate $1 million to your favorite charity than give it to Uncle Sam to spend for you. So what we did is we sat down with them and showed them literally, here's what we're going to do. Yes, we need some income streams, and yes, we need some assets, and we want a little bit of cash liquidity, but here's how we're going to do it in such a way that you're only going to pay tax on the money when you use it. So, you were talking about when you retire and you have your money in these accounts, and, you don't want to lose 20 to 30% to the market, but you're willing to lose 20 to 30% to taxes. Well, yeah, let's arrange your affairs so that we're minimizing that risk, because once you have that money, once you've saved enough, it's not like if you have that much more, you're going to spend that much more, right? If your income needs are $100,000 and your investment needs are situated such that to create that $100,000, well, if that's, I'm just making up, if it's $2 million creates $100,000 for you, if you grow to $4 million, it's not like you go spend $200,000. You still spend $100,000. But if your $2 million drop to $1 million, you're going to take a pay cut.
Then
you're going to be stressed.
Yep.
So you should be looking at it the same way. You should not be taking excess risk in your portfolio, and you should not be paying excess tax, because not only do you not want to lose the 20 to 30% to the markets, you don't want to give up 20 to 30% of your income. And that's what this couple decided. We could sell the building, we could sell the businesses, and we could do it in such a way that they literally had about $500,000 cash that we could take out and stick in an account. So we could do that for them to give them the flexibility. They wanted to pay off a house to do some things. So we could give them that cash, no taxes on that portion of it. The other $2.5 million went into very specific trusts, very specific accounts designed in a way that they could have all the money they need. Next year, if they want to take all $2 million out, fine, pay tax on it, but only pay the taxes when you need it.